So in our previous session, we looked at, we introduced May 2023 question 3, and we explained the concept. So I want to believe that if you missed the class, you had the time to watch the video and catch up on the concept we explained from that class. So just a quick update for those who join. So these notes, I get to share it after each class, and it's a continuous note. So you'd find in this note that all of what we've covered, all the questions we've covered from the start of our preparation, you're going to find it in this note. So if you scroll up, you're going to see the questions and solution from the first one we started. So if you're looking for the most recent one, you have to scroll down to the last, please. I would also drop that in the WhatsApp group when I'm sending it. But I just thought I should mention it. So you have that up to the very start of what we've done. So you can always just go back to the videos if you need to, and then you can then look at the notes if you need to copy or get your solutions together or something. So you have this shared at the end of every class. It just takes you from where we started for this diet down to where we stop at the end of that class, and then we add to it in subsequent classes, so that at the end of our preparation you would have a consolidated question pack that we have touched on during these free sessions, really, because they are free sessions. Okay, so let's get right into our plan for today, which is 2 questions really. The first is May 2023 question 3, and then the second would be May 2025 question 3 as well, and that would conclude our consideration of discounted cash flow. All right, so just a quick update on some of the things some of the key topics we'll touch on today. We've already discussed it, but just to emphasize it again for your note. So in this question in front of us, at the end of the topic, you should be able to complete your NPV discounted cash flow computation using the concept. Sorry, I need to add someone. Okay, so at the end of today's class, you should be able to complete your discounted cash flow computation regardless of the nature of the question, applying the principle of expected value. So that's one of the topics we're going to touch on in our class today, the concept of expected value. Yeah, expected value. So we explained what expected value is in our previous video and how to do it. So we're going to, with our calculation, with our computation as well, we're going to touch on that quickly as well. You also would learn at the end of this class how to apply the principle or approach questions around money / nominal rate of return, or cash flow. Let's begin with cash flow. Money / nominal. So money and nominal refers to the same thing. So you're going to learn the principle how to adopt any question that has money or nominal cash flow versus money / nominal rate of return. So if you don't understand what these concepts are, please refer to our previous, the most recent video on that. Before this one, we explained that. We're going to also look at the concept, how to apply the concept of real rate of return versus real cash flow. Then we're going to also touch on the topic sensitivity analysis. Okay. Sensitivity analysis. So these are all of the topics we'll cover with this question under the topic discounted cash flow. So all of these topics or subtopics fall under the discounted cash flow in our syllabus. Right. So let's get right into our computation. I'm not going to repeat try not to repeat everything that we've done last week, but if required, as I go ahead with the computation, I'll just touch a little bit on it as well. Okay, so let's get right to it. We're going to read the question one more time. We read it last week, but we're going to read it one more time, and then we get right to a solution, given we've already discussed the theoretical aspect and the concept around the question. So let's get right into it quickly. All right. So it says, Tinko Limited is considering an expansion project. Project will involve the acquisition of an automated production machine costing 11 million and payable now. The machine is expected to have a disposal value at the end of 5 years, which is equal to 10% of the initial expenditure. The following reflects a recent market survey regarding the estimated annual sales revenue from the expansion project over the project's 5 years. Let's pause a little bit and explain the concept, what we've read right up to this point quickly. So they're considering a new project, which is an automated production machine. It's going to cost them 11 million payable now to get that project up. And then the scrap value would be 10%. So I wrote it by the side last week. So 11 million, 10% gives us a scrap value now of 1.1 million. So that's the scrap value, 10%. It now tells us that the next paragraph, that this is the estimated annual sales revenue from the project expansion over the project's 5 years. So we have the sales at different levels or expected probability levels. So we're looking at high, medium, low. Those are 3 possibilities. We're looking at the amount. If we do have the high level or core, we're looking at the sales value for medium and low, the amount, as well as the probability of those values actually happening or occurring rather. It is expected that the contribution to sales ratio will be 50%. So once you compute your sales, your contribution will be 50% of the sales. That's what that means. Additional expenditure on fixed overhead is expected to be 1.8 million per annum. So that's fixed overhead. TL incurs a 20% tax on corporate profit. Corporate tax is paid 1 year in arrears. We've explained those principles before now. TL's after-tax nominal money discount rate is 15.5% per annum. A uniform inflation rate is 5% per annum. A uniform inflation rate of 5% per annum will apply to all costs and revenue during the life of the project. 5% will apply to all costs and revenue during the life of the project. All of the values have been expressed in terms of current prices. That is highlighted. We explained that last week. So when we say current prices, we mean they are all real cash flow, and they have not been adjusted for inflation, or inflation has not been applied to those values. You can assume that all of the cash flows occur at the end of each year, and that the initial investment does not qualify for capital allowances. Required: evaluate the proposed expansion from a financial perspective. That's A1. 2, calculate and interpret the sensitivity of the project to changes in expected annual contribution and the tax rate. B, you have now been advised that the capital cost of the expansion will qualify for written down allowances at a rate of 25% per annum on a reducing balance. Also, at the end of the project's life, a balancing charge or an allowance will arise equal to the difference between the scrap proceeds and the tax written down value. So we explained that principle in our very first class and the very first question we solved. So we have an opportunity to practice that again with this. You're required to calculate the financial impact of these allowances. All right, so there we have it. So let's get right into it with our A1. Evaluate the proposed expansion from a financial perspective. So whenever you have a question that mentions, that just says evaluate an investment, the default method or the method that readily comes to your mind would be one of two: NPV and APV. So those are the two default methods. So you don't have to start thinking about, oh, which method do I use to evaluate this project? So whenever the question is not specific and just mentions evaluate an investment proposal, the methods that should come to your mind immediately should be the net present value method and the adjusted present value. So how do you know how to use between both? We touched on it before, but let's quickly do that quickly. NPV. Rather, let me begin with APV because that's the one that's an exception. So APV would generally be used in situations where you have details around the financing of the project. So when you have a question that gives you details around issue cost, subsidized loans, which is also referred to as government grant. And sometimes too, gives you details around other sources of finance. So it gives you a detailed breakdown to tell you, we're going to, out of the total amount we require, we'll get 50 million on commercial loan, we'll get 10 million on subsidized loan and all of that. So when you have a question that gives you this detailed breakdown, issue cost, subsidized loan, the approach would be your adjusted present value. So we have a question on adjusted present value that would come on much later on. Now, if your question does not have any of these details, you're left with just one method. That is your net present value. And that is what would be used for all other questions by default. So guys, please keep this at the back of your mind in terms of what method to use when you have a question that says evaluate a project. All right, so if you really want to get some of the key principles around NPV, we've discussed it in our first class, as well as a 40-minute video on key principles, and all of that, and it's the presentation format we will be using in this class. So there are two acceptable presentation formats, but for this class we will be adopting just one so that it remains consistent. Whichever method you use, you're always going to arrive at the same answer. Okay, so that was a quick shift. Let's get back right to our question because we've already explained all of this before now. Okay, so we're looking at our NPV. So in our NPV, let's look at what we have. One is we have our sales over the project's 5 years. So these are the sales. We have our contribution. So right here, we have our sales. Right here, we have our contribution as 50% of sales. And right here, we have our fixed costs. Okay, so let's get these values out and then we can compute what our net cash flow is based on that. So let's begin with our sales. Our sales is based on the principles of expected value. And we explained in our previous class that whenever you have different values or different possible values and the probability attached to them, so whether you're having that for sales, for variable costs, for fixed costs, for rent, whenever you have these situations, the value you would use for that cash item would be your expected value. And how do we derive your expected value? Just multiply the different values by the by the probability and sum it up. So let's see what our sales would be for 5 years. So we're going to multiply the different possible values by the probability and then sum it up. So that would be 16,000 multiplied by 0.5 plus 12,000 multiplied by 16,000 multiplied by 0.25, not 0.5. 12,000 multiplied by 0.5 and then 8,000 multiplied by 0.25, and that gives us our total sales. If we had the same thing for variable cost, we do the same thing to derive our variable cost. If we had the same thing for rent, we do the same thing to derive our rent. But in this question, we only have that for our sales. So let's do that. Let's calculate what our annual sales would be. And that is what is called the principle of expected value. So we explained it in our previous class. So you might want to look at that if you want more details on that. So Tinku PLC. So our sales. So the project is for 5 years. So this will be our sales for year 1 to 5. So year 1, year 2, year 3, year 4, year 5. So these are our sales. So this will be our annual sales. So let's compute our expected sales. These are the principles of expected value, and that's where that topic comes from. Okay, so if at any point you have any question, guys, just so that we keep it a little bit organized, just make use of the hand raise feature. I would always be checking that, and then I would call on you to ask a question. And if you prefer to drop it in the chat, you could also drop it in the chat as well. I'll be checking that regularly, but chat might be a little bit slow, but I will definitely be checking that regularly. Okay, so these are our expected sales. So it's the multiplication of the individual values by the different probability, and then we would sum it up. Okay, so what do we have? Let me catch my calculator quickly.
12,000.
Okay, please just a moment. Someone is asking in the group for the link. Maybe someone could just let me drop that. Okay, I think someone has dropped that. Okay, great. All right, so let me get right into it. Okay, so that's 16,000 multiplied by 0.25 for the first one. So this is 4,000. 0.5, which is half, that is 6,000. 8,000.25, which is 1/4 of that, which is 2,000, and gives us our 12,000. So the question tells us that this is the projection for 5 years. So what it basically means is that it will be 12,000 at sales in year 1, year 2, year 3, year 4, year 5. We're going to come back to that. For now, we're just calculating our sales. So that's the first thing we've computed. The next thing we'll compute based on available data is our contribution. So what's our contribution? It tells us right here that the contribution to sales ratio will be 50%. In other words, our contribution will be 50% of our sales. So can we establish what our contribution would be then? Our contribution will be 50%. So our contribution to sales ratio is 50% of our sales. We establish our sales to be 12,000. So that would be 50% multiplied by 12 million. They are million rather, so I took off 3 zeros. Please just think of that. So let me just add that additional context. It's a million, I took off 3 zeros so that it's easier for me to compute. So 50% of 12 million, but since we took off 3 zeros, that's 12,000, gives us 6,000. So that's our contribution. Okay, so that's our contribution. All right, so let's get right into it. We know very well in our values, in our, our format that we presented earlier, that whenever you're presenting your profit statement, you would always have, let's recap that quickly, and then we'll just get right back to our computation. So we explained in our previous class, so you don't need to include this in your computation, just a little bit of a shift for those that just joined. So we had in our presentation format that whenever you're trying to determine what your profit is, you would have your sales. So you can refer to our very first class for this format as well. You would have less your variable cost, and that gives you your contribution. And then you less your fixed cost, and that gives you your cash flow before tax based on the format we are using. Operating cash flow, you can call it operating cash flow before tax. We can then charge your tax, whatever that is. Then you have your after tax operating cash flow. And then if we have capital allowance, we can bring in tax savings on capital allowance. So tax savings on capital allowance, so whatever that is. If you have loss carried forward, you can have your tax savings on loss carried forward. So whatever that is, and that gives us our net cash flow. We can then have your discount factor, whatever that is, you have your present value. So this multiplied by this. So that's just a quick recap. So you can have that for year 1, year 2, year 3, etc., depending on the duration of the project. Okay, so that's just a quick digression, really. Okay, so back to our solution. We've established our expected sales will determine our contribution. So up to this very point, they've given us the value at 6,000. So that's why I need to bring that format. So they've given us the value at 6,000. So we know that we already know what the contribution line is. So back to our question. So let's see if we have a fixed cost in our question. If we don't have, we move on. If we have a fixed cost, we then bring it in, and then we can then go ahead then. Okay, so the question tells us that our fixed cost, additional expenditure on fixed overhead is expected to be 1.8 million. We're taking off 3 zeros in our computation, so that is 1,800. So our fixed cost would be 1.8, taking off 3 zeros. So we have a fixed cost here as 1.8. Okay, I'm going to solve it. I'm just presenting it, just putting in the format so you know how it will flow generally. All right. So we have our fixed cost as 1.8. All right. So any other details? Tax, capital allowance, loss carried forward provision. If there is none, we know that is where our solution will stop. We can then present it formally. I've not presented it. That's just a distraction. Okay. So the question says right here that you should note that the initial investment does not qualify for capital allowance. So in this part of the question we're solving, initial investment, there's no capital allowance because it doesn't qualify. So that means that would not be applicable for our solution. So clearly, we're not going to have tax savings on capital allowance. The question does not mention loss carried forward. So for our solution, if you want a question that has this, you can look at the previous question we solved. These two would not be applicable. All right. So now let's get back to our solution now. Let's get now right back to our solution then. This was just a distraction. So let's get back to our solution. Maybe I should have put it down. Okay, so let's get back to our solution now. So for Tinko PLC, we have our sales as 6,000. We've already computed that. Less variable cost. We have our contribution I'm sorry, sales 12,000, guys. 12 sales 12,000, guys. Sales 12,000. Yeah, so that's our expected sales value up here. That's our expected sales value up here. Where's that? Yeah, 12,000, guys. Okay. We don't have a variable cost, but we have a contribution. We have a contribution given to us as 6,000. We have fixed cost given to us as 1,800, and that this gives us our operating cash flow before tax of 4,200. So guys, what do you think variable cost is? 12,000 minus what would have given us contribution of 6,000? 12,000 minus 6,000 would have given us 6,000. Would have also given us 6,000. That's our variable cost. Now, at this point, we need to pause before we move forward. And the reason is because we explained something last week. I'm not going to explain it all over because I asked you guys to watch the video, but I'm just going to move on with the computation. We said last week quickly that if your cash flow, the values you are given for your computation, so these are 4,200 is what we have for year 1, year 2, year 3, year 4, year 5, because that's the constant value based on our question. We're not giving the values for different years, the constant value. Okay, now if the cash flow you are giving the question is the money or nominal, both refers to the same thing, cash flow, we would discount it using what rate of return? We would discount it using a money or nominal rate of return. And if your cash flow is real cash flow, so by real cash flow that has not been adjusted for inflation, or what is referred to as current price terms. So if it is real cash flow or current price term, you would discount it using the real rate of return. Now, if the question is silent, just assume that you are not making any adjustment. You're just computing it as it's meant to be. So if the question is silent, so what I mean by this question is silent, in other words, the question doesn't tell you if the cash is money or nominal. The question doesn't tell you if the rate of return is real or nominal. So if that is the case, we would generally assume that the right rate of return is given. So what do I mean by that? The question doesn't tell us if it's a nominal or real cash flow. So I just assume that they've given the appropriate rate of return. So if I've calculated 4.2 and I go to my question on rate of return or cost of capital and I see 10%, the question doesn't tell me if that 10% is real or nominal. I will just use the 10% as it is because the question is silent. I can't begin to assume what I'm given. So I'll just use it as it is. But if the question tells me that the cash flow is real cash flow or current price term, then I must use the real rate of return to discount it. And if the question tells me that the cash flow is money or nominal, then I must use the money or nominal rate of return to discount it. If the question is silent, I use the values that I'm given without bothering about making any form of adjustment to them. So before we go further, let's go back to our question and see if the question, does it tell us the type of cash flow we're given? Does it tell us the type of rate of return we are given? And then we'll do what we're meant to do. If you want further explanation on this, please go back to our last two videos. Our last video and the videos I shared, I set the link to the group. So let's go to our question quickly. That's what you would always do whenever you're answering a question on cash flow. All right. So the question tells us right here, and I'm not going to read it all over again because we read it. At this very spot, the question tells us that the after-tax nominal, which is also called money, discount rate is 15% per annum. So you know from that line that the rate of return, the cost of capital, is given to you in money slash nominal term. So once you see that, your mind should go quickly to what we just explained. And what did we just explain? Which we explained before. If you are given the money on nominal rate of return, the cash you should use should be what? Money on nominal cash flow. So these values were given. If it is money on nominal cash flow, we are fine. We don't need to make any adjustment. We'll just go ahead and discount. But if it is a real rate of return, then we need to take the next step. So let's look at what the cash flows are given. In what terms are we given those cash flow? So let's look at our question. It says right here, all the prices above have been expressed in terms of current prices. So what are current prices? What are current prices? What are current prices? Current prices are your real cash flow. So those are your current price terms. So in our question, we're given real cash flow and we are given money slash nominal rate of return. So we cannot use the money or nominal rate of return to discount the real cash flow. We explained it before now, because money rate of return would go with money cash flow. Real rate of return would go with real cash flow. So we have two options. And for this question, I explained when we discussed last week, I said that we would quick solve both using both methods, and then you would decide for yourself which one you are more comfortable with. And then in subsequent questions, we will not solve both. We just pick one. But just for the purpose of illustrating, since it's the very first class, we will do both. Now you have two options. Option one, is our cash flow, or the cash items, or whatever your monetary values here. They are real. So we have one option. The first option is to convert those real values, or convert the real cash flow to nominal or money cash flow. So once you convert it to money or nominal cash flow, we can then use the rate of return we are given. We can then use the money or nominal rate of return given. Please, if you want to learn more about this term, please refer to our previous videos so we don't go back on that. Then use the money slash nominal rate of return. So that's our first option. We convert the cash flow to nominal money. And when we say we convert it to nominal money, we basically just apply inflation. That's what we basically mean, just apply inflation. Because remember what we said, the money and nominal cash flow are values that have been subject to inflation. So that's our first option. Our second option, because money cash flow must go with money rate of return, real cash flow must go with real rate of return. We use the cash flow as it is. We don't change it. So we use the real cash flow, which is what we're given, or current price term cash flow. But we convert the money slash nominal. But we convert the money slash nominal rate of return to what? To what? To real rate of return. So those are the two options you have. You are not meant to do the both of them. Just pick any of them and then you are good. So I want to do both for this specific question, just for this question. So let's proceed. Let's begin with option 1. So let's begin with our option 1. What is our option 1? What the values we're giving it in real price terms. So we convert it to money cash flow. And how do we convert it to money cash flow? By applying inflation. So let's apply inflation. But first, let's bring out the years first. So its project is 1, 2, therefore 5 years, 3, 4, 5. So therefore 5 years. So we explained that the operating cash flow is 4.2 for the first at the beginning of the project, which is 4.2. So we need to apply inflation to convert it to money cash flow. So let's go to our question and see what the inflation is so that we can apply it right away. Okay. So where do we have inflation? Okay, so the question tells us right here, a uniform inflation rate of 5% per annum will apply to all costs and revenue during the life of the project. That was the entire life of the project. So a 5% inflation rate would apply. So let's apply that our inflation quickly. So 5% per annum, 5% per annum. So we're adding 5%. So what would that be? It applies throughout the year. So we don't need to repeat all of this for all of the different years because it's a constant value. So let's begin from 4.2. We already showed how to get here, so there's no need to repeat it. It's a constant value. So let's continue our computation from where we computed up to 4.2. So our operating cash flow before tax, it is 4.2. We're applying inflation. It says inflation rate of 5% will apply. So what will be the value in year 1 applying inflation? So that will be 4.2 multiplied by 1.05. So adding 5% to our value. So what do we have as our nominal cash flow for year 1? Well, the calculator close by. I don't know. I always look for my calculator. So what do we have, guys? 5%. We're adding 0.05 to the existing value. That's why it's 1.05. So 4.2 multiplied by 1.05. What do you guys have? Okay. Does anybody? Okay. So I have 4,410. Hope you have the same thing. Yeah, thank you.
Yes.
Thank you. All right. So the same value multiplied by 1.05 for the next year. So the same thing for the next year too, because it's 5%. It's a uniform value every year. So that would be 4,410 multiplied by 1.05. So what do we have? So we'll just round up the last one. I don't want to use decimal place. It can be very, but if you are comfortable using this decimal place, you can use 4630.5. But I don't like decimal places. They can be a little bit messy sometimes and make the computation a little bit stressful to subtract. So I'm just adding my Naira and the fact that I took off 3 zeros because that is 1,410,000, but so that's clear. Okay, so 4631, the next one multiplied by 1.05. So that is 4862. Okay, the next one multiplied by 1.05, that is 5105. Next one multiplied by 1.05, that gives us 5360. You all had the same value. if there's a difference, it might be that maybe you round it up and then you multiply with the rounded up value. I was just multiplying it with my next answer. So that's why I got all of this. But if you round it up, if you're multiplying the rounded up value, you might have a little bit different value. But if you're multiplying the answer directly by 1.05, you're just going to have all of this. It doesn't matter. It doesn't really matter what the difference is not material. All right, so that's our nominal or money operating cash flow. So with that, we can then get back to our format and continue where we stopped. Okay, so let's get back to our format and continue where we stopped. In our normal format, we've determined what to do. So our normal format is, we have determined the operating cash flow before tax. The next thing is what? Is our tax. So let's look at our tax. Let's get our tax in. I should have given some space just in case my tax takes me to a different year. Okay, so let's look at our tax. So what is our tax rate and when is the tax paid? So let's get right to our question. What is our tax rate and when is the tax paid? Okay, where's our tax? All right, it says TL incurs a 20% tax rate on profit. Corporate tax is paid 1 year in arrears. Very important information, 1 year in arrears. So what does that mean? Your year one tax payable 1 year in arrears would be in year 2. Your year 2 tax payable 1 year in arrears would be in year 3. Your year 3 tax payable 1 year in arrears would be in year 4, etc., and so on and so forth. So let's do that quickly. Our tax I should have added one extra. So let's some space because our year 5 tax payable 1 year in arrears will be in year 6. So let me see if I can squeeze in one more year into this place. So this is 5360, 5360, 5360. Hope I don't forget 5360. If I don't forget 5360. Okay, so let me put year 5 a little bit closer. Sorry guys, I should have thought of the fact that we might have an extra year based on tax, or even 2 years, depending on whether it's paid 1 year, 2 years, or 3 years in arrears. Okay, sorry, what was the value again? And I was just calling it out. Please, what was the value again? Sorry.
360.
5. Okay, thank you.
5360.
5. Yeah, 5360. Thank you. So I don't have any cash. Yeah, thank you. We don't have any cash in year 6, but tax will take us to year 6 because tax is payable 1 year in arrears. So let's do our tax then. The tax rate in the question is 20%. Okay, so what is 20% of 4410? Payable 1 year in arrears, meaning it's payable the next year. So what is 20%? 0.2 multiplied by 0.2 multiplied by 4410. I have 882, but it's payable 1 year in arrears, means it's payable the next year. So it's only payable the next year, 1 year in arrears. Okay. So what is 0.2 of 4631? 0.2 of 4631. 926.2. I don't want to work with decimal places. It can be, I don't want to work with this. So I'm just rounding it up to 926. Payable 1 year in arrears. So it's payable in this year. %, 20% rather of 4862. 972. Payable 1 year in arrears. 20% of 5105. 1021, payable 1 year in arrears, payable in the next following year. 20% of 5360, which is the last one. 1072, payable 1 year in arrears. That's what added in the year 6 to our computation. 1072. Okay, so that's our tax. The question tells us that there is no capital allowance, so that's why we're not doing capital allowance. It tells us here that the investment does not qualify for capital allowances. So We're not doing capital allowance. There's no mention of loss carried forward, so we're not doing loss carried forward. But if there is, we'd make use of it in our computation. If you want to see a question that has capital allowance, please go to our very first question. I think either our first or second question has that. All right, so let's get right back to our computation. So let's go to our investment now, because all of this money you use to generate the revenue, you need to invest some money into it. So let's see what's our investment. Oh, sorry, we've not done our after tax. We've not done our after tax. So let's do our after tax. Or we can do investment. There's no need. We can do both. We can just put it together. There's no need to subtract and then come back to it. So we can do it. Okay. So let's get right to our investment then. Okay. Let's get right to our investment. So how much are we investing in this project to set up the project? How much are we investing to set up the project? How much does it take to set up it? In the very first paragraph, it says that the project will involve the acquisition of an automated production machine costing 11 million and payable now. So no inflation because it's payable now. Inflation is going to be at the end of the year one. This one is payable now. Now, right now, which is at the very now, not at the end of the year. So our investment, which is here 0, is payable now. Not at the end of the year. If it was payable at the end of the year, then inflation would apply because at the end of year one, there's an inflation of 5%. But it is payable now. So that is 11,000. And that is because we took off 3 zeros in our computation. Very important. Now, when we've incurred this investment, at the end of year 5, what happens? Do we abandon it? Do we sell it? The project, the machine, do we sell it for any value? Let's go right back to our question. Question tells us that the machine is expected to have a disposal value at the end of 5 years, which is equal to 10% of the initial expenditure. So what is the value? What's our disposal value? Let me do it here, and then I'll come back to my computation. Okay, so let me call this scrap. So investment money is going out of our hands, please. So our scrap value. Okay, so let's I just want to do a walk-in somewhere. Just a moment. Okay, so I want to do a walk-in somewhere here. Okay, so our disposal is 10% of the investment. So 10% of our 11,000, because we're taking off 3 zeros for our computation, gives us 1.1 million. Now, if the question doesn't begin to mention whether it is nominal or real cash flow, we use it as it is. But there's an important information in the question that we must not miss out. This 1.10, in what price term is it? Is it in money or is it in nominal? Because if it is in nominal price term, if it is in nominal price term, we're fine. But if it is in real price term, we need to adjust it for inflation, because definitely what you would sell that asset now, just like someone has a land. If you're telling me that you're looking at selling the land for, keeping it simple, 1 million now, in 5 years time, definitely it will no longer go for 1 million. It will go for much higher than 1 million. That is because of the impact of inflation. So our disposal proceed of 1.1. Let's go to our question. In what price term is it? Let's go back to our question quickly, and then we can then move forward. Move a little bit fast. My plan is to get done with this the next few minutes. All right. So very important thing not to forget is this sentence here. It says all of the values above, as in every single value above, every single, all of them, there's no exception, have been expressed in terms of current prices. All of the values. And one of the value there is our scrap value. So the scrap value we just computed now is scrap value of 1.1 we just calculated now is current price term, which is real cash flow. So we need to move it from real to nominal by applying inflation, because that's what we do when we're moving from real to nominal. We just apply inflation. So let's apply inflation to that. So now it is 1.1. So what will be the value in 5 years from now? Very easy. We apply inflation for each of the years. So that would be 1.1 multiplied by 1.05 gives us the value at the end of year 1. Multiply by 1.05 gives us the value at the end of year 2. Multiplied by 1.05 gives us the value at the end of year 3. Multiplied by 1.05 gives the value at the end of year 4. Multiply by 1.05 gives the value at the end of year 5. Or put simply, if you wanted to use a formula, a format for it, put simply, it is the future value is equals to the present value 1 plus the inflation rate raised to the power of number of years. So that would basically be 1.1 multiplied by 1 plus the inflation rate is 0.05. How many years? 1, 2, 3, 4, 5 raised to the power of 5. So whichever approach you use, you'd have the same answer. So what do you guys have? So you can use the format approach, or you can just do the straight manual approach to also determine what each of the value is. What do you guys have, please? What do you have? Who has done it?
1404.
1404. So whichever method you use. Okay, so our scrap value in year 5, which is the end of the project, we only have year 6 because of tax, is 1404. Okay, is there any question on the scrap value or anything up to this point? Because we want to sum up and just discount. That's just the last item. Okay, so I want to believe it's clear then. If it's not clear, please feel free to ask. All right, so let's get right into quickly so that we can get done with method 1 quickly. Okay, so let's do that quickly. We don't have capital allowance, we don't have loss carried forward, so we are good. So our net cash flow, this is 11 negative. Sorry, this is tax, so this should be negative for year 6 as well. So this is 1072. So those are the easier ones. There's no values under them. Okay, so that there's another easy one here. There's no value under the year 1 as well. So that is 4410. So those are nominal net cash flow. And then the next one, sorry, I need to quickly add someone. Okay, so the next one, 4631 minus 882. So please, you guys help me also confirm it, because sometimes when punching calculator, you might punch the wrong value. So this is 3749. Please, if I punch the wrong value, please just draw it to my attention. 4862 minus 926. 3939. 5104.36. 5104 minus 972. Sorry, let's check this calculator again. 5105 minus 972, 4133. Finally, this other one is pretty straightforward, so I had already dropped that down. 5360 minus 1021. And then plus 1404, which is 5743. Five, 7, 4, 3. Okay. All right. So sorry, just a moment. Let me check my chart, see if there's anything there. Okay, there's nothing in the charts. I promise to check those. Okay. So those are net cash flow. So we now we have our nominal or money net cash flow. So let's discount. We use the nominal rate of return that we're giving in the question, sharply and discount. Okay. So what's our nominal or money discount rate? We're given that in the question. So we just discount that quickly. We just use that and discount quickly. So the after-tax nominal or money rate of return is 15.5% per annum. So that's our discount rate. We have a money on nominal cash flow. So we use the money on nominal discount rate and get it out of our way. So that is 15.5%. Okay, so let's compute. I showed you guys the formula for this last week. Sorry, not last week, when we first did our first class. So let me just write out the formula. I'm not going to compute all of them for you guys. So I'll just pick the value from my discount formula table. But the formula is 1 divided by 1 plus the rate of return or cost of capital raised to the power of n. N is the year. Or 1 plus the rate of return raised to the power of minus n. So it's either you use this or you use this. This is 0. Anything raised to the power of 0 is 1. So we are good. So for the subsequent one, the next one would be 1 plus 15.5% will be 0.155. So that would be 1.155 raised to the power of 1. Raised to the power of minus 1, rather. I'm using the second formula. Raised to the power of minus 1. Or you do 1 divided by 1 plus r raised to the power of n. So that gives me, for the next year, 0.8658. So 0.866. Now, for some calculators, scientific calculators, once you press equal sign, it gives you the next value. I don't know what calculator you use, but if you don't use that, you need to do it for every year. So the next year would be, if you are using this second formula I gave, it would be 1 plus 0.155 raised to the power of minus 2. If you're using the first formula, it's 1 divided by 1 plus 0.155 raised to the power of 2, depending on which formula you're using. So that gives us 0.750. I'm sure we're used to discount factor computation. 0.649, 0.562, 0.482, 0.421. Okay, so let's multiply it and get our present value. 11 multiplied by 1 is 11. Negative. 4410 multiplied by 0.866. It's 3819. 3749 multiplied by 0.750. 2812. Rounding up all of my values. 3936 multiplied by 0.649. 255. 4.46. So we can run that 46 round to 2445, 2554, because that one is not up to 5. So that's 2554. $4133 multiplied by 0.562, 2323. 5743 multiplied by 0.4182 to 4. Okay, sorry, I think I must have pressed the wrong value. I pressed 4182 instead. So 5743 multiplied by 0.482 to 768. To 768. That's my calculator. 2768. And then finally 1072 multiplied by 0.421, 451. Okay, so hope we all had the same answer. So I can just double check on mine just in case I. Okay. I'm just double checking. I think my discount factor for year 5 doesn't look correct, but let me just reconfirm that. Just a minute. 1.155 raised to the power of minus 5. Okay, 0.487, I think. But can someone please reconfirm the discount factor for year 5? 5743. Yeah, I think it's not correct. Well, let me do that again. I did 1.15 when I was doing my computation. All right, so 1.155 raised to the power of minus 5. So that's 0.487. I wrote 0.482. Okay, so this is 0.487. I wrote 0.482 in error. Okay, so let me just correct that. Okay, 0.487, yeah? So 0.487.487 multiplied by 5743. So that is 2797, not 2768. Okay. 2797. Okay. So what's our NPV? Just add everything. So our NPV is, sorry, this is a negative sign. The last one is a negative sign. So this is minus, minus, minus. It doesn't suddenly become plus here. All right, so let's sum it up quickly. So minus 11,000 plus 3819 plus 2812 plus 2554 plus 2323 plus 2797 plus 451. So I have 2854. 2854. Great. All right. Any question on the first approach for us, guys?
Yes, so just sir, please.
Yeah. Go ahead.
Please, the discount factor, please. How do I punch it on my calculator to get the 0. For year 1, the 0.866? Okay, since so it's 15.5, I'm using the second.
Okay. Okay. So this is the format in front of us quickly. Let me use the sorry, I need to add someone quickly. Few people are just rejoining. All right. So let's look at it together quickly. The format in front of us for the second one is 1 plus r raised to the power of minus n. So that would be 1 plus, what is our rate of return? 15.5%. So 15.5 divided by 100 to take it into nominal value would be 0.155. So raised to the power of minus 1. So that's basically 1 plus 155 raised to the power of minus 1. And that is what gives us 0.8. It is 865. Something, so I run it up to 866 to keep it to 3 decimal place. So for year 2, it's minus 2. For year 3, minus 3. For year 4, minus 4. Is that clear?
That's it. Yes, thank you very much, sir.
All right. All right, you're welcome. Nazif, please go ahead.
Yes, sir. Well done, sir. Please, the last one, when adding the PV to get the NPV, the last one, it was a negative sign, 451. You said add 451.
No, minus, sorry. Minus
Okay, it's
451
minus.
was a
Okay.
negative sign.
Okay.
Yeah.
Okay. Thank you very much, sir.
Yeah. So 11,000 and 451 are negative. Okay. All right. Now that's our first approach. Now let's go to our second approach quickly so that we can catch up with time. We need to get this question out of our hand at the minimum today. So let's do, I should have done just one, but for the purpose of the fact that I'm illustrating this method, so you can choose for yourself when you're practicing more question, which of the methods to use. So method 2. So what is our method 2? We said that real cash flow will go with real rate of return. That's what we said. So for our method 2, we've agreed that we're not going to make any change to the cash flow. We're giving the real cash flow, which is current price terms. So we're going to use it as it is. However, we are going to convert the money rate of return to the real rate of return. So let's do that part first. Because we already know what the real cash flow is. So we just continue our computation from there. Where we have a problem right now is being able to know what convert the money or nominal rate of return to the real rate of return. So whenever you're doing that, we use what is called the Fisher's effect. And this is the formula for doing that. So the real cost of capital is equals to 1 plus the money rate of return divided by 1 plus the inflation rate. Where's my hand? So 1 plus the inflation rate minus 1. Now, if you are given the real rate of return and you wanted to calculate the money rate of return, just fit the real rate of return here and find the missing value. That's what you do. That's what you do. Or alternatively, maybe I just write a reworked formula for that, which also works. If you have the money rate of the money rate of return, you're trying to find the real rate of return. If you solve that formula, it gives you 1 plus the money rate of return is equals to 1 plus the real rate, 1 plus the inflation rate. So you would use this formula. You would use this formula if you are given the money rate. If you are given the real rate and you're trying to find the money rate. You would use this formula if you are given the money rate and you're trying to find the real cost of capital. So you use this one if you are given the money rate and you're trying to find the real rate. You'd use this second formula, which is the reworked of the first formula, if you are given the real rate. That's what you are given in the question. And you are trying to find the money rate. Now you don't need to know both. It's basically this formula is just a rework of this formula to bring the money rate this way. It's just a rework of the formula. So if you're good with math, just find the missing value, if you plug it in. But if you want the rework formula where you don't have, that cuts off some of the steps, you use this. So with that said, let's calculate our real cost of capital quickly. So we're using the first one because we're given the money rate. We're trying to find the real rate. So we're using the first one. So our real rate of return is equals to 1 plus the money rate. What is the money rate? 15.5%, which is 0.155. 0.155 divided by 1 plus the inflation rate. What is our inflation rate? What is our inflation rate? Who wants to remind us? I must have forgotten that. What was the inflation rate that we're using throughout the question? What is our inflation
5%.
rate again?
5%.
Yeah, our inflation rate is 5%, which is 0.05, or 5 divided by 100. Okay, which is 0.05. So whatever you have minus 1. Okay, so what is our real rate? So 1 plus 0.155 is 1.155. 1 plus 0.05 is 1.05 minus 1. So what do we have? Whatever you have, to get it back to percentage, you just multiply by 100 to get it back to percentage. So what do we have? 1.155 divided by 1.05 minus 1. 0.1 to get it to percentage. To get it to percentage, we multiply by 100. So our real rate of return is 10%. So that's clear, guys. Okay, so with that out of our way, we can then do our computation. Now, there are two ways to do our computation, but we're going to go with the shorter one. Don't forget that the real rate of return, the current price terms is the value without inflation. Without inflation. So what that basically means for us is that our after-tax operating cash flow before tax. What it basically means for us is our operating cash flow before tax for year 1, 2, 3, 4, 5. What is the value in real price terms without inflation? That's what we did first. Operating cash flow before tax without inflation is 4.2. So what it basically means is that it is 4.2, 4.2, 4.2, 4.2, 4.2. Now we can do this. Oh, so what am I doing? Oh yeah, 4.2. We can do that. However, the shorter method is to use annuity factor. So whenever you have a constant method, you have a constant value over a number of years, you can use annuity factor to solve it. But if you are comfortable with presenting for all of the years, then go ahead and do it. So I'll leave you guys, I'll do annuity factor method, but I'll leave you guys to resolve this question using this same approach. You arrive at the same answer. What do I mean by that? Just compute the tax, 20%, and put it in here for all of the years. So you now have year 6, so compute the tax, then compute, once you compute the tax, bring in the investment, it doesn't change, 11,000, bring in the scrap value. You are not going to inflate it because we're going to use the real price term, which is 1.1, which is the value as at now. So bring in 11,000, bring in 1.1, not the nominal value or inflated value, but 1.1. So once you bring all of that in, you would arrive at the exact same answer if you present it this way. But I want to do it using annuity factor because oftentimes when I can't give you a constant value, they expect to use annuity factor for it. But if you want to play with it, maybe I just leave that as an assignment for you guys. You can play with it and drop it in the group. But like I mentioned, two things to not miss out. This will not be 1.04 because this is an inflated value. So this has to be 1.101. Please take note of that. 11,000 doesn't change. And then when you come to the discount factor, you use 10% because that is a real That is the real rate of return. You're going to have exact same value. But let's go to what I would recommend, because oftentimes when ICAN gives you a constant value and they want you to use the real rate of return, it might be for like 10 years. And imagine doing this for 10 years or 15 years. Your booklet will not contain that. So let's go with the standard method we would use when you have a constant value, and that is to make use of annuity factor. So I'll leave you guys this one as an assignment. So let me just note it somewhere. Complete using same format. Complete using same format above as an assignment. So you're going to arrive at the exact same value. The only difference would be that your scrap value under year 5, please use 1.1. Please, that's the only thing, because that's the current price term for that. We use 1.404 because we inflated it to the nominal value. All right, so let's use format 2, but we're going to use annuity factor. So by annuity factor approach, we just aggregate the values. We aggregate the values. That's what we mean by annuity factor then. So let's do that. So we can present it in this format, or we can present it in a different shape. So we can call the item or description, whatever you want to refer to it. We can refer to the year or the years. We can put together the net cash flow, our present value, and then, okay, this is, no, I think I'll call it discount factor then, not a present value. Our discount factor or annuity factor. And then a present value. Okay, so let's look at that period then. All right, so let's go to our project then. In year 0, we'd spend 11,000. That's pretty straightforward. That's our initial investment. So we group, so in annuity factor, we group all of the constant values together. That's what we do in annuity factor. We group all of the constant factors together. Okay, so in year 0, I'm going to put on a description. In year 0, we will spend 11,000, and that is for our initial investment. Okay, that is for our initial investment. Our discount factor, we're using the, because we're using the real cash flow or current price term, our discount factor has to be 10%, which is the real rate of return. So don't forget that. So this has to be 10%. So that is our initial investment. From year 1 to 5, which is the reason why we're using annuity factor, the cash flow is constant, which is every year 42, 42, 40. So if, for example, you had 15 years, it would be year 1 to 15. So here we have year 1 to 5. That is our profit before tax. So for each of those years, it is 4.2. So if it's 20 years, year 1 to 20, we do that. If it's 30 years, year 1 to 30. And that's why annuity factor format is pretty much easy compared to when you have to write out all of the years. All right. So we're going to do our profit before tax for year 1 to 5. Our tax. Don't forget our tax is payable 1 year in arrears. So that is from this our computation, you can see that the tax is paid from year 2 to year 6. So our tax is from year 2 to year 6 because it's payable 1 year in arrears. So the period we paid would be year 2 to year 6. And then I'm going to come back to that, what the value is. And then our scrap value, which is a residual value. We're going to dispose of our investment, 10% of that. We're not attaching inflation to it because we're using the current price terms without inflation. So 10% of our 11,000 or 11 million is 1.1. So I'm going to come back to the tax because of that 1 year in arrears part. So that will be in our year 5. All right, let's now do our tax quickly. So what will be our tax value? Now, pay attention to this. What is our tax rate? So I can just call this, what's our tax rate?
20%.
20%. Thank you very much. Now pay attention to this. We are paying the profit before tax is 4.2. Tax is 20%. So how much is that? How much is that? What do you guys have? 840.
40.
Is that correct? Thank you.
Yes.
Now
Yes.
pay attention. Yeah, now pay attention to this very important tip. Now the 840 is payable 1 year in arrears, which is the following year. It is payable 1 year in arrears, which is the following year. We're interested in the value in current price terms, the value as of now. So if the tax is payable in the year that we generate the profit, assuming we're paying the tax year 1, we pay the tax in year 1, year 2, we pay the tax in year 2, year 3, we pay the tax in year 3. Just like we have our profit before tax, we generated 142 in year 1, we generated 42 in year 2, we generated 43 in year 3, we generated 43 in year 4, and so on. We would have just put 840 here. If it is payable in that specific year. But because it is payable 1 year in arrears, it is not payable in that year, we need to adjust this to reflect the current price terms. So we need to adjust that to reflect the current equivalent. Now, if you are doing this method, this one, I ask you guys to do it, you don't need to make that adjustment because you are doing it year by year by year. But because it's annuity factor we're using, we need to make that adjustment. So please take note of that. Because it's annuity factor we're doing, we need to make that adjustment. If you are doing it for all of the years, you don't need to make that adjustment because they're accounting for each of the years. But in this method, we're aggregating it. So we need to find the current price terms. So please take note of that. So for this method, you just have your 840, 840, your computation, and that would work just fine for you. All right. Now let's go back to our adjustment. All right. So how do we adjust it to reflect the current equivalent? Pretty easy. We have a format for that. And everything we do, we have a format for that. It is the relevant cash flow divided by 1 plus the inflation rate raised to power of n. So n here is equals to number of years in arrears. So if it is 1 year in arrears, n will be 1. If it is 2 years in arrears, n will be 2. If it is 3 years in arrears, n will be 3. So how many years in arrears do we have? 1 year in arrears. So what is our current price terms for our tax? So that would be the relevant cash flow is 840 divided by 1 plus inflation rate is 0.05 for 5% rather, which is 0.05. How many years in arrears? 1. So that would be 840 divided by this raised power of 1. So 840 divided by 1.05. So what do we have? What do we have, guys? Here's my calculator.
$800.
Yeah, so we would have 800. That's an important principle to bear in mind, guys. If the tax was payable year one, payable in year one, year two, payable year two, we don't need to make this adjustment because it's payable in that year. So what you have is the value for that year. But because it's payable 1 year ahead, you need to adjust it to bring it back to the current price terms. Any question on that part? Because that's something principle to really get, and then we can then move forward quickly with the remaining ones. The remaining sections are going to be a little bit straightforward. Okay, so if there are no questions, let's move ahead quickly then. All right, so let's get our discount factor, and then we can then multiply. So this is tax. The money is going out of your hand, so that has to be negative. So that is tax. That is tax. Money is going out of your hand, so that has to be negative. All right, so let's do this quickly. So this is 10%. Anything raised to power 0 is 1. We already mentioned it. Anything raised to power 0 is 1. So this would still be our 11,000. These are annuity factors because they're for a group of years. So I'll come back to that. Year 5, what's our discount factor? Okay, no. So we need to calculate it again because it's 10%. It's not 15%. Okay. So our year 5 is 1 year. So that would be 1 plus 0.1 raised to the power of minus 5. It's for 1 year. So what do we have for that? That's also pretty straightforward. And then we'll come back to the annuity factor part. So 1.1 raised to the power of minus 5. So 0.621. That is pretty straightforward as well. Okay, so what do we have? 1.1. Those are just for single years. So those ones are pretty straightforward because we've already discussed the formula for that. So that is 683. 683. Okay. So that leaves us with the annuity factor, which are the group of years. So let's do our annuity factors quickly. So we have a formula for annuity factor, which is when you group, which is what we compute when you group years. When you have a constant value and grouping the years, we make use of annuity factor. So our annuity factor formula okay. So annuity factor formula is, so where's my pen? Okay, so it is 1 minus 1 plus the rate of return raised to the power of minus n, which is the number of years for the project, not inflation adjustment for the project, divided by R. So your R is your rate of return. Your N is project lifespan. Okay, so let's plug it in quickly to get our annuity factor for year 1 to 5. So let's do year 1 to 5 quickly. 1 to 5. So that would be 1 minus 1 plus our rate of return, which is our real rate of cost of capital, which is what we're using. 10% is 0.1. Raised to the power of is 5 years, year 1 to 5. So minus 5. Divided by your R, which is R 0.1. Okay. So this will be 1 minus, so 1.01, sorry, 1.1 rather, raised to the power of minus 5. What do we have? Raised to the power of minus 5. So I have 0.621 divided by 0.1. Okay, so what do we have? 1 minus 0.621 divided by 0.1. So I have 3.79. So that's 3.79. Okay, so what do we have? 42 multiplied by, so this multiplied by this, multiplied by 3.79 gives us 15,918. Okay, gives us 15,918. Okay, any question on that annuity factor quickly? Okay, now let's move to the next one. Tax, year 2 to 6. Now pay attention to this as well, because this is one area students would often make mistake. This is year 1 to 5, so the entire 5 years. This is year 2 to 6, so 1 year is not part of, year 1 is not part of it. So what we're going to do for this, when you have a situation like this, is we compute our annuity factor for the 6 years, and then we take off year 1. So let's do that quickly. Let's do that quickly. Let's do that quickly, and you get it. So the annuity factor for year 2 to 6. So first, 1 to 6. So we can calculate for 1 to 6, which is the entire period from the beginning to the end. So that would be, a format is 1 minus 1 plus r raised to the power of minus n divided by r. So that would be 1 plus, sorry, not 1 plus, 1 minus. The formula is 1 minus. Okay, so that's 1 minus 1 plus 0.1 raised to the power of minus 6 divided by 0.1. What do we have, guys? So whenever you're calculating annuity factor, is for the entire period from 1 to 5. So if you say n is equals to 4, that's basically 1 to 4. If you say n is equals to 10, that's 1 to 10. If you say n is equals to 20, that's 1 to 20. So that's something to take note of. Okay, so what do we have? What do we have that? So I have 1.1 raised to power of minus 6 gives me 0.56, whatever it is, minus 1 gives me 0.4355 divided by 0.1. So that's 4.355. I'm taking off the negative sign because I was working the other way around. So that is 4.355. Now this is year 1 to 6. But we're interested in year 2 to 6. So we need to take out the part or the years that we're not interested in. So how many years are we not interested in? We've computed for year 1 to 6, because whenever you use the one n, it refers to the beginning to that n. So if you use n as 4, it refers to 1 to 4. If you use n as 5, it refers to 1 to 5, which is what we wanted. If you use n as 8, it refers to 1 to 8. If I use n as 6, I refer to 1 to 6. So now I've computed 1 to 6, but I'm interested in 2 to 6. That's what I'm interested in. So which of the years from 1 to 6, which years are we not interested in? We're interested in year 1, right? Is that clear? Sorry, we're not interested in year 1. That's what I mean. We're not interested in year 1. So we're going to less the value for year 1. Because we don't need year 1. Because we don't require year 1. We only require year 2 to 4. So when you have year 1 to 6, and then you take out year 1, it leaves you with year 2 to 6. So let's determine what year 1 is, and then take it out. So that would be quickly 1 minus 1 plus 0.1 raised to the power of minus 1, which is year 1, divided by 0.1. So what do we have? Okay, on my calculator, I have 0.9091. Okay, so what is now our value for year 2 to 6? So that's 4 points.
Hello, sir. Sorry, sir.
Yes, please.
Yes, sir. Please, sir. Sorry
Yes,
to
please.
cut you. Please,
No,
are we
please go ahead.
supposed to use annuity formula again for year one alone? We are only doing 1 year.
Okay, so I'm going to explain that again quickly. Our tax is for what year? Let's look at it together. Our tax, for what period do we pay the tax? We pay it in year 2 to 6. Is that clear? Is that one clear? Is that part clear? Is that part clear?
Yes.
Okay, great.
I
Then.
understand we are looking.
Great,
Sorry,
great,
sir. I understand we are looking for year 2 to 6.
Yes, please. Yes, please.
For the tax.
Yes, please.
But now we
Yes.
want to remove year 1 from
Yeah.
1 to 6. We want to remove year 1 so that we'll be left with 2 to 6. So what I'm saying is that getting the tax for year 1, are we supposed to use the annuity formula to get for year 1 only? That's what I'm trying to say, sir.
Okay, so you got it right up to the point where you ask whether we need to use it to get for year 1 only. Yes, you can use it. You can use the annuity factor to get for year 1 only, or I just want it to be consistent, or you can also use the discount factor formula. It gives you the same value. So can you try that quickly? So 1 plus r raised to the power of minus 1, it gives you the same value. I just want it to be consistent. That's why I just use the same thing. It's going to give you the same thing. So that would be 1 plus 0.1 raised to the power of minus 1. What do you have? Or if you're using the other formula, 1 divided by 1 plus 0.1 raised to the power of 1. Can you quickly check that? I just wanted to keep it consistent. So that's why I see use the same formula, because I knew to give you the same value. So can you quickly check that, please? Can you confirm that for us quickly? What do you have?
Sorry, sir. I'm not using my calculator is dead. My calculator is dead.
Okay, so can someone that has the calculator confirm what you have, please?
It's the same answer. I use annuity and then discounting factor. It will give the
Thank
same
you very
answer.
much. Yeah, so you get the same answer, but I just wanted to keep it simple. That's why I just said, let me just still use annuity for it as well. Hope that's clear.
Very clear, sir. I understand.
Yeah, and and the reason why I specifically used it is because, let's give an example. It's because if, for example, you were interested in year 3 to 6. If you're interested in year 3 to 6, so what years do we not require?
That means we don't need year 1 to 2.
With the hand. So if I'd used this other one for you guys, you might be a little bit confused in this situation, because you might be beginning to think, okay, what do I use? What do I use? But you will just know that, okay, I'll just change this to 2. And I am good. So that's why I just decided to keep it consistent with that format, that formula. Is that clear?
Very clear, sir. Thank you, sir.
Yeah, so that's why I decided to keep it constant. So I'm going to take it back to my 1. Okay, so that's why I decided to keep that consistent with that. All right. Temilola, your hand is up. Is it the same person I just spoke with? Maybe I missed that earlier or something.
I am the one, sir. I will put down my hand. Thank you.
All right. Yeah, thank you. All right. So let's get our values up quickly so that we can get down. So 3.446. So 3.446. Okay, let me make a little change. I have been consistent with 3 decimal places, so I don't want to make this 2 decimal place so that it be consistent. Otherwise, my answers will be a little bit different by some fraction, because everything I've used my discount factor, I have been consistent with 3 decimal places. I've always been consistent with 3 decimal places. So can we recalculate our discount factor without rounding up, and then we know? So what I mean by that is this. So let's recalculate this so that I can get 3 decimal places, so that I will be consistent with 3 decimal places across. Otherwise, when you round up some to 2, some to 3, some to 4, your answer will not be consistent. It will just be a little fraction. So let's redo this one, but not rounding up. Not rounding up to 0.621, so that the values are all consistent. So so that the values are all consistent. So this is what I'm going to do, so that I keep the decimal places all to 3 decimal places. So this is what I'm going to do. Where's my pen again? Okay, so this is 1 minus 1.01 raised to the power of minus 5 divided by 0.1. Okay, so let's do it all over, but keep that so that it's all consistent. So that would be 1.05 raised to the power of minus 5 gives us 0.783, whatever it is, minus 1 gives me minus something. I'm going to take off the minus sign because I'm working backward. So that minus sign is not relevant. Divided by 0.1. Oh, sorry, not 1.01, 1.1. That's 10%. 1.1, not 1.01. Not 1%. 1 plus 0.1 is 1.1. Okay, so that's 1.1 raised to the power of minus 5, 0.6209, whatever it is, minus 1 divided by 0.1. Okay, so just to keep it consistent, what do we have for 3 decimal places so that I can keep all of them consistent? 3.791, so that I can keep it consistent, so that all of my values are on the same layer. Otherwise, I'm going to have some differential. 3.791. Okay, so let's do this quickly down. 42 multiplied by 3.791. 15,922. Quickly, and quickly round up this. Spend a lot of time with explanation. Multiply by 3.446. 2757. 2757. So this is tax. This is minus. This is 15. Let me calculate it again. 42 cannot be multiplied by. Yeah, that's correct. All right. 42 multiplied by 3.791. Yeah, 1592. Okay, can we get what our value is? So what is our NPV? Should give us exact same value as when we used the first approach. So what do we have? What do you have, guys? Minus 11,000 plus 15,922 minus 2757 plus 687. What do you have, guys? What do you have? What do you guys have? Sorry, my calculator is what's wrong with my calculator? All right, so 2848. 2848. Okay, so that is it the same? Is it the exact same thing as when we did the other approach, or we did the nominal cash flow part? Okay, so 2854. I guess difference is minimal. This what do you call it? Impact of rounding up or something. Any question? Any question?
Hello,
okay,
sir.
so those are two methods. So those are the two methods we typically use. So either method you use, you're going to arrive at approximately the same answer. Maybe a very minor difference due to the impact of rounding up here and there. Otherwise, you're going to arrive at the exact same value. Any question on the both methods? So which of the two methods do you guys prefer?
Hello, sir.
Yes, please.
Good evening, sir. Sorry, please, I just want to ask a little question, sir. This format, okay, if you are giving working capital in this question.
You're giving what?
Yes. I'm just asking, okay, let's say we also have working capital in this type of question now.
Yeah.
So will this follow as what's called? the same process, adding what? Subtracting it in the year 0 and also adding back in the last year also. In this,
yes, if it's yes, and if it's constant, if the working capital is constant for every year, we'll use annuity factor. But if it's maybe just year 0 and year 1, or maybe just 2 years, you can just present for just those 2 years. Just like we presented year 0 and year 5 separately, because those are separate values. They're not constant over a number of years. But for the values that are constant over a number of years, you aggregate them and make use of annuity factor. So it all depends on what the working capital value is.
Okay, sorry, I just want to clarify that. So we are following the same process.
Yes, please.
Lessening it in the year 0 and adding back in the last year. That's what I just want to confirm for the working capital. Okay, thanks.
Yeah.
Thank
you. Yeah. Okay, so you can just pick which of the two methods. So you don't need to, in a situation like this, you're not doing the two. So whichever of the two methods you use is accepted. Yeah, sometimes the answer between the two might be a little bit different, just a few fractions. So you could say that this is 28, what's the value here? What's the value here? Yeah, 2854, and this is 2848. So that's basically the impact of rounding up. That's basically the impact of rounding up of some of our values. And all right, so let's move on, right? Let's move on then. So we're done with that. So do we proceed with the investment? Yes, it is a positive NPV, so we should proceed with our investment. So let's put that quickly. Recommendation.
Sorry, sir. I was trying to listen to you. So the table for the annuity factor that we just did, I'm just trying to write my own. So since
you don't do what?
Yes. I'm trying to write
and I'll share. No, I'll share it. I'll share the notes. So I'll share the notes so that we don't slow down, please. I want to get this done before the end of the question done. I'll share the note. Is that okay? So that we don't slow a little bit down. Yeah, thank you. Thank you for understanding. Thank you so much for understanding. Okay, so our recommendation, because our NPV is positive, we will proceed with the investment. So let's do our recommendation. The projection shows a positive NPV of, we can use the value for the last one we just computed, which is 2848. Positive NPV of 2848 million. We're taking off 30 before, so it's written our three zeros. And as such, should be undertaken. Yeah, if it's a negative NPV, we will not proceed because that is a loss. But if it's a positive NPV, we would proceed because that indicates a profit. All right, so let's get right back into our question and look at our B part of our question quickly. All right, so that's our A part. We've evaluated it, 10 marks. We're good to go. A2, calculate and interpret the sensitivity of the project to changes in expected annual contribution and tax rate. So sensitivity is another topic in our discounted cash flow topic. So when we say sensitivity, what do we mean? Generally, strategic financial managers, when they're done with their computation, they're interested in asking themselves one basic question: how sensitive are my values on the NPV? What impact would they have on our net present value? For example, when we say sensitivity, we say, by what percentage can we accommodate a fall in sales before we get to a negative NPV? Because if it's a negative NPV, we shouldn't go into it. And these are projections. You might be wrong by your projection. So assuming we are wrong by 10%, would our NPV be negative? Would we go into a loss zone? Assuming we are wrong in our contribution by 20%, will we go into the loss zone? That is what sensitivity is all about. That's what the sensitivity is all about. Or we look at our cost. We projected that our fixed cost will be 1.8. Assuming our fixed cost is not 1.8, it grows by, say, 100%. Will we go into the loss zone? And that is the question sensitivity analysis answers. By what percentage change can we accommodate without our NPV running into the loss zone? So how do we determine it? Now, it depends on the particular element. Just remember, I mentioned sales, I mentioned fixed costs, I mentioned whatever it is. So it depends on what element or relevant cash flow you're trying to find sensitivity for. However, whatever you're trying to find sensitivity for, this would be our formula. Now that you understand what sensitivity is all about, by what percentage, by what value can a particular item drop or increase? Drop if it's a revenue, increase if it's cost, before we begin to find ourselves in a negative NPV, because we don't want to undertake a project that will result in a loss. We're not a charity organization. So sensitivity. I've explained the concept, so you can just write a few notes out of what I've just explained. So how do we determine the sensitivity of a project? The formula is pretty straightforward. It is your base NPV, in other words, whatever your NPV calculation is, divided by the present value of the relevant cash flow net of tax. So if you're looking at sensitivity of sales, it will be the present value of sales. If you're looking at sensitivity of, say, fixed costs, it will be the present value of your fixed costs. If you're looking at sensitivity of, say, what I use in a question, say contribution, it will be the present value of contribution net of tax. Your base NPV is always constant. So let's go ahead with it. So we can use the first one, we can use the second one. But I want to use the second one because it's going to be easy for me, because I'm going to use annuity for my computation. So that would make it easier for me. If I use the first one, I have to be looking at, if I want to do, for example, I want to do present value of fixed costs, I have to be looking at the fixed costs for each of the years. So that would be a longer step. But if I use my annuity part, I'm going to just focus on the annuity, which is for the group of years. So let's do our sensitivity quickly. We're short of time. Let's do our sensitivity. So what is our first sensitivity we're looking at? What is our first sensitivity? What is our first sensitivity? Sensitivity of the project to what?
Yes.
No, let's look at our question very well. Okay, so our first sensitivity is to what? The expected annual contribution. That's our first sensitivity. And the second one is to the tax rate. So let's look at the sensitivity to the expected annual contribution. That's our first one. Okay, so our sensitivity value is the base case NPV. So it is, so for the A part, it is the base case NPV. So our NPV does not change. Divided by present value of annual contribution, because that's the relevant cash flow we're looking at. Annual contribution net of tax. Annual contribution net of tax. So let's do that quickly. So what is our contribution from our question? We know our NPV now. We're using method 2. We're using the annuity factor. We know our NPV now. NPV is 2848. So we know that. So what's our contribution? What's our contribution? Our contribution. Our contribution, not our operating cash. So our contribution. What's our contribution?
6,000.
Mm-hmm.
6,000.
So that is our contribution, 6,000. And that is for each of the years. So that would be 6,000 year 1, 6,000 year 2, 6,000 year 3, 6,000 year 4, 6,000 year 5, the 5-year project. So let's do that quickly. Our contribution for 5 years. Okay, so our contribution 1 to 5, 6,000. So it's for 5 years. So we use our annuity factor because it's for 5 years. I'm using my format 2 computation, and my annuity factor based on format 2 is 10%. We already calculated what our annuity factor is for year 1 to 5. Can we just copy and drop it so we don't stress ourselves? Year 1 to 5, we already computed what the annuity factor is. So this is year 1 to 5. What's the annuity factor?
3.791.
Thank you. 3.791. 3.791. Okay. So what's the present value for that? So 6,000 multiplied by 3.791. What do we have? 6,000 multiplied by 3.791. So that gives us 22,566. 22,566. Now, before you move forward, and don't forget our formula. Net of what? Net of what? Tax.
Yes,
Net of tax. So we need to we need to calculate what the tax is. Net of tax. So what is our tax rate again?
20%.
Our tax rate is 20% of 6,000. So what do we have as that? I need to add the page. I'm moving a little bit fast because I want to get this done today. Okay, so what's 20% of 6,000? So that is 1,000. Yeah, Cecilia, I see your hand. I'll call you. Let me just finish computing the tax. I see your hand. I'll call you right now. So that is 1, 2. But don't forget something we said. Because we're using method 2, the tax, is it payable in that year? So year 1 tax, is it payable in year 1? Is it payable in year 1? No.
Year 2.
Our tax is payable 1 year in arrears. Our tax is payable 1 year in arrears. So year 1 will be payable in year 2, year 2 will be payable in year 3. So basically our tax is for 2 to 6. That's what our tax is, for 2 to 6. So our tax is for 2 to 6. So this one tax, this 1 to be payable next year. So we need to bring it back to current price then. And I gave you guys the formula to do that. So what's the formula again? Let's go to our computation much earlier to bring the value back to current price term. These are formula. You remember the formula, right? Relevant cash flow divided by 1 plus the inflation rate raised power of n. So that would be our relevant cash flow is 1.2 divided by 1 plus the inflation rate is 5%. That doesn't change. Raised power of n. N in this case is equals to the number of years in arrears, and this is just 1 year in arrears. Our tax is 1 year in arrears. So divided by 1.05. So what do we have? What do we have? 1143 as our tax. 1143 as our tax. Our annuity factor for year 2 to 6, we've calculated it before, so we don't need to calculate it. So let's go and just copy it as it is. For year 2 to 6, our annuity factor is 3.446. So that's 3.446. 3.446. Okay, so what do we have as our tax? Then I'll take Cecilia's question. So we have as our tax 3939. Okay, so our after tax is 18,807. Okay, Cecilia, please go ahead.
Yes, that contribution, I don't know, maybe it's my own calculation, because 6,000 multiplied by 3.791, I got 22746.
Okay, so let me quickly do that again. Thank you. Let me quickly do my calculator. Sometimes you can, when you're punching calculator, you can sometimes punch the wrong value. So 3.791. So when I still had the value, I still had the value in my calculator when I subtracted. So if it is 18,807 as the final answer, then that will show, because I had the value, saved my calculator, I just recalled it and subtracted the 3939. So, but let me do it again. 3.791 multiplied by 6,000. Yeah, you're right, 22,746. So if you subtract 3939, it should give you 18807. So it means I must have written down the wrong value from my calculator. Does it give us that? The answer shouldn't change because I just does it give us that value, or I need to change the value final answer to? $22,746. Okay.
Yeah, so the answer is correct. The answer is
because so I think I saved it in my calculator memory, but then I wrote down the wrong. So I guess my brain was seeing something else and I was writing something else. All right. Thank you so much for that. Thank you for that. Okay. So now that we've computed our contribution, so let's put it in our formula now. Let's put in our formula quickly. Our NPV, that doesn't change. That one doesn't change. That one doesn't change. Our NPV is 2848, so that doesn't change. So our sensitivity would be 2848 divided by the present value of the relevant cash flow, which is our annual contribution net of tax, 18,807. To get it in percentage, we just multiply by 100. So what do we have? So let me add 100 multiplication by 100 to it to get it in percentage.
15%.
Okay, so that is roughly 15%. So what does this tell us? What does it mean? It basically means that your contribution must not drop below 15%. Once it drops below 15%, you enter into a loss zone. So let's write that down. So what it basically means, is the above implies that the total contribution can drop by maximum of 15%. By maximum of 15% before the NPV becomes negative. Any question on that? Now, bear in mind, just one more time, that if this tax is payable in that same year, we will not do this adjustment. We'll just put our 1 2 here. I've mentioned it a number of times before that. The only reason why we're doing this adjustment is because it is payable the next year. We're trying to adjust it to reflect the current price terms. That's the only reason why we're doing that adjustment. So please bear that in mind. Please bear that in mind. All right. Let's get the second one quickly. Sensitivity to what? Our formula remains base NPV, which is 2848. That one does not change. But the second one will change, relevant cash flows. What is our second sensitivity? Sensitivity to what? What's our second sensitivity? What's our second sensitivity quickly? Okay, so our second sensitivity is sensitivity of the project to change in the tax rate. To change in the tax rate. In other words, to change in tax. So change in tax. So let's have our second one quickly. So our formula remains. Our formula does not change. As long as they're looking at the sensitivity of the project to something, our formula does not change. It is our base NPV. Our NPV remains 2848 divided by the present value of relevant cash flow net of tax. Our NPV does not change. We've calculated it from the very start, which is 2848. So divided by the present value of the cash flow we're considering this time is our tax, which is our taxation. So tax cannot be net of tax again because we're looking at tax. If it was maybe any other item, it would be net of tax. But because it's tax, you cannot have tax net of tax. So it's present value of our tax. So let's look at what our tax is from our computation. So we'll go to our computation because we're using the format 2 for our sensitivity analysis. We'll go to our computation of tax in our question for the annuity format question. So what do we have as our tax? What do we have as our tax? For year 2 to 6. What do we have as our tax?
2757.
2757. So that one is pretty straightforward. So that would be 2848 divided by 2757. To get it in percentage, we multiply it by 100. So what do we have? 2848 divided by 2757 multiplied by 100. So what do we have? 103%. So who want to quickly describe from what I've said before? Let's hear someone's voice. What does this mean? Who just want to take a try? Tell us, what does this mean? We explain what sensitivity is, and we explain that if it is revenue, whatever rate you calculate is a decrease in that value, because fall in revenue will decrease your NPV. And if it's a cost item or an expense item, whatever value you calculate is an increase, because any increase in that value would impact on your profit. So if I say a sensitivity of tax of 103%, what do I mean? Or what do we mean? Who would want to give that a try for us? What does it mean?
Hello, sir.
Yeah, please go ahead. Hello, yeah, go ahead. Yeah, please.
So I just want to try actually.
Okay, please do.
From what I understand is that if the tax rates increase beyond 103, it will impact on our profits. It will affect our contribution of our profits. So if it increase beyond 103.
Very true. So if our tax, which is currently 20%, increases beyond 103%, our NPV will become negative. In other words, we will run into a loss. So that's what it basically means. So let's write that down. So what we basically mean is that our current tax rate let me just rewrite it in a concise way. An increase in our current tax rate above 103% will result in a negative NPV. So let's add one more step. It's not part of this question. So currently it is 20%. An increase of 103% means what is the maximum our tax rate will be? Pretty straightforward. That would be the value bracket 1 plus the sensitivity rate. So that is currently, our current tax rate is 20%. So that is 20 multiplied by 1 plus, our sensitivity rate is 103%. So 103 divided by 100 is 1.03. So that is 2 points. So 20 multiplied by 2.03, what do we have? 40.6%. So if the government by any chance increases tax above 40.6%, our project will go into the loss zone and would no longer be profitable to us. So that's an extra step. It wasn't required in this question, but an extra step just in case you're asked to compute what the maximum tax rate would be before it goes into the loss zone. Okay. All right. So that's sensitivity. So we've used this question to also cover sensitivity analysis. So when you have a question on sensitivity of something, just bear this format in mind. Whatever your NPV is divided by the base case of the relevant cash flow for the entire year. So it can be sales, it can be contribution, it can be tax, it can be variable cost. The same format, the same formula would apply. Just use the relevant item that you're being asked about. Okay. Let's see if we're done, or so let's see if we're done, or we still have one more, because I needed us to round up this. I thought we could finish this content, but all right, let's look at our B part.
Sorry, sir. Please, I have a question.
Okay. Quickly, please, because we have 15 minutes. Yeah. Please go ahead.
Yeah. Sorry. What you just did now, sir? The value bracket 1 plus sensitivity. So can we also do that also for the profit also, because what we did now is about the cost. Yeah. Okay, so
let's do that. Let's look at it quickly. I'm going to spend just a minute on that. So there are two different things. So, but you're going to approach them differently if it's a revenue or a cost item. So So we said an increase, and that's why we are adding. Okay, we said an increase, and that's what we're adding. For our contribution, which is the revenue item, we set a drop or a decrease. So if I'm going to do that, I'm going to subtract. So for a contribution, for revenue, which are income item, it would be the value bracket 1 minus, because we're looking at a drop, not an increase, sensitivity rate. Is that clear? Is that clear? Sorry, can I get some feedback?
Yes, sir. It's clear.
So if we're going to do this, let's even do it quickly. So our annual contribution is 6,000. So that is the value. Minus 1 minus, what's our sensitivity rate for contribution? So what's our sensitivity rate? Where is it? 15%. So that is 0.15. So that would be 6,000 multiplied by 0.85. So what is the contribution was not fall below what value? It must not fall below what value? It must not fall below 5.1. If it falls below 5.1, we would go into a loss zone. Is that clear?
All right, sir. Thanks, sir.
Yes. All right. So let's get right back to our final part of our question, please. So just take note of that. If it's a drop revenue, it's a fall, so we subtract. What if it's an increase? We add. Okay, so let's look at our final part quickly. It says we have finished all the computation we've done up to this point. It now says you have now been advised. Don't forget that in our first computation, we said that there's no capital allowance. It now said you have now been advised that the capital cost of the expansion will qualify for tax for written down allowance at the rate of 25% on a reducing balance method. Okay, on a reducing balance basis. Also, at the end of the project life, a balancing charge or a balancing allowance will arise equal to the difference between the scrap proceeds and the tax written down value. So it just wants to see if you can calculate how capital allowance is treated if you had one. You are required to calculate the financial impact of this allowance. So if we had capital allowance, what would have been the financial impact on our computation? So let's do capital allowance computation, assuming we have it qualifies for capital allowance at 25% tax written down value. So let's do that quickly, within the next 10 minutes. So that's whatever value we have, that's what we would typically have put here under tax savings on capital allowance if that was included in our original question. But right now, we're only going to calculate the financial impact. How does our profit increase or fall as a result if we had capital allowance? So let's do that quickly. So we'll do that in the next 10 minutes. Financial impact if there was capital allowance. Okay, so there are different ways you can present it, but I generally like presenting mine this way. So you would have the year, you would have the description, you would have the opening balance, you'd have, for want of space, I'll write TAD, tax allowable depreciation, that's what it means. You'd have closing balance, you'd have the tax savings, which is what we need for our calculation. This is the key. And then you would have the year. What year do we place it? What year do we place it? Okay, so let's begin with our year one. So our year one, there is an investment. How much is the investment? How much did we spend to set up our project? Can you guys remember? How much do we spend to set up our project? Because it's a capital investment, a fixed asset that is subject to capital allowance.
11 million.
11 million. So let's just take off 3 zeros since that's what we've been doing all this while. So our opening balance is 11. Let's leave it at 11,000. So I'll just put it here that I'm taking off 3 0. Okay, our tax allowable depreciation is at what rate? At what rate in our question? Just mention it, that our tax allowable depreciation is on reducing balance at a rate of what? It mentions it right in our question, at a rate of 20% per year. So let's do that quickly. In the final year, we'll have a balance in charge or a balance in allowance. We explained this concept when we solve our very first question. Our final year is year 5. So when we get to year 5, we will pause and can compute a balance in charge or a balance in allowance when we get to year 5. So we'll pause. So we'll have year 1, year 2, year 3, year 4, and then year 5, which is our final year. All right. So let's get right into it quickly. So this is 25%. Sorry, where's my pen? Okay, so this is 25%. Okay, so what is 25% of 11,000? Because that's our annual depreciation value. 11,000 multiplied by 0.25. What do we have? 2,750. What is our closing balance? 11,000 minus 2,750. What's our closing balance? What's wrong with my calculator? What do I keep pressing? 2,750. Okay, 8,250. So 8,250. I will come to this other part later on. Let me complete this part, which is pretty straightforward. Our closing balance becomes our opening balance the next year, which is 8,250. 25% of 8,250, what do we have? $2,063. So 2,063, taking off the decimal. So then you need to put it in bracket. There's no need. Okay, so 2,063. So 8,250 minus 2,063. What do we have? 6187. Closing becomes opening the next year. 6187. 25% of 6187, I have 1547. So 6187 minus 1547, rather, what do we have? 4640. Closing becomes the opening. 4640. 25% of that is 1160. So 4640 minus 1160. What do we have? I was on my calculator. 1160. What do we have? 3480. In our final year, we'd have a balancing charge or a balancing allowance. So how do we describe that? We explained it right before now. So in our final year, we'd compare the opening balance which is 3480 with our disposal proceed. Okay. With our disposal proceed. So how much did we sell this asset? Now this can get a little bit, before you move forward, just notice that when we're presenting our depreciation, we're doing it every single year. And out of the two methods we use for our computation, the method where we presented every single year is our method 1. So to keep it consistent, we just use the depreciation from our method 1, which is, what's our depreciation, which was our scrap value 1404. Just to keep it consistent. If you still use 11, you're not wrong. If you decide to use 11, you're not wrong. You're not wrong, but just to keep it consistent. So that's 1404 as our disposal proceed, 1404. All right. Now, because we sold the asset for less than the opening balance or making a loss, we sold the asset for 1404. The current tax written down value of the asset is 3480. So because of that, we're making a loss. And when we make a loss, what we incur what is called a balancing allowance. So what is the difference? 3480 minus 1404. That gives us 2076. 2076 as a balancing allowance. Now, if you want to understand more the concept of balancing allowance and balancing charge, please refer to, maybe I could drop the video in a group so we can make some progress. The video on 40 minutes on NPV. I took the time to explain the concept very well. Yeah, so these are all our computation for each of the years on our tax written down value. However, what we're interested in our format is not the tax written down value. What we're interested in is what? Let's go to our format quickly. What we're interested in is not the tax written down value. What we're interested in, based on our presentation format, is the tax savings. The tax savings on the capital allowance, the tax savings on the written down value. So how do we get the tax savings? Very straightforward. Just multiply the capital allowance by the tax rate. So just multiply these values by the tax rate. And our tax rate is 20%. So multiply by the tax rate of 20%. So 2750 multiplied by 20%. What is our tax savings? $550. 2063 multiplied by 20%, 413. 1547 multiplied by 20%. What does that come to? 1547 multiplied by 0.2. 309. 309. 1160 multiplied by 20%, 232. And finally, 2076 multiplied by 20%, it is 415. Tax is payable because it's tax savings. Tax is payable 1 year in arrears. So we would claim the allowance when tax is payable. What it basically means is that our year 1 will claim it in year 2 because it's a tax savings and tax is payable 1 year in arrears. Our year 2 will claim it in year 3. Our year 3 will claim it in year 4. Our year 4 will claim it in year 5. And our year 5 will claim it in year 6. So what impact does it have on our profit? Our calculation is never complete without discounting. Our calculation as strategic financial managers is never complete without discounting. So can we quickly discount these values and then we can then close out quickly? I will just put out the values and let you guys finish that up. So you have year 2, which is our first year, 3, 4, 5, 6, which are these years. These are the years right here. And then we have our tax. Oh, sorry. I should put the year up. I should put this up. I should put this up. Then you have our tax savings. And then you'd have our discount factor. Okay, so our tax savings, I'm just copying the values up. 550, 413, 309, 232, 415. Straightforward. Our discount factor, we use format 1 for different years. So let's just copy what the discount factors are for all of those years. So we don't need to do all this computation again because we already have them. So these are the discount factor. For year 2, it is 0.750. For year 3, 0.649. For year 4, 0.562. For year 5, 0.847. For year 6, 0.421. So we're not doing any computation again. We're just copying the values down. That's the good thing about strategic financial management exam. Most of your values, once you compute them the first time, you would just be reusing them. So let's do that. We're almost there so that we can complete it. So 550 multiplied by 0.750, I have 413. 0.649. I'm just copying the values from up. 413 multiplied by 0.649, I have 268. So one can also reconfirm the values because this is 0.562. Copying it from what we have up. I have 179. 0.487 copied from up. I have 113. 0.421 copied from up. I have 175. Okay. So our last line, let's sum it up. So let's sum up this plus this plus this plus this plus this. Okay, so what do we have? By my calculator, I have 1143 as the net benefit. So let's write a line to summarize that. So we can say that our net cash flow will increase by 1,143,000 because we're taking off 3 zeros in a calculation if tax allowable depreciation is considered. Okay, so that's it, guys.